Uber Technologies has been running up over 39% year to date. I'm going to explain why I bought this company, what I think the future growth prospects of this company is, and why I think this company might still be undervalued. Now, Uber is not the same company it was a couple years ago. A couple years ago, Uber was unprofitable and a cash flow destroying business. Now they have become profitable and management is focusing on long-term growth and becoming a compounding machine. It's important to focus on the growth prospects of the future of this business and not the growth prospects of the past. As you can see on this graph, you can see how Uber has continuously generated significant free cash flow over the past few quarters. This is a significant improvement considering it was unprofitable just a couple years back. Now let's go into the earnings report and review how this company is doing. This CEO says, "We kicked off the year with yet another quarter of profitable growth at scale, with trips up 18% and even stronger user retention. Supported by the consistent strength of our core business, we continue to build towards the future, including 5 new autonomous vehicle announcements in just the last week." The CFO says, "We delivered over $2 billion of quarterly free cash flow with multiple levers in our control to generate industry-leading cash flow growth. We remain focused and disciplined on capital allocation to drive greater financial durability and are on track to deliver against our multi-year plan." So all around, this is something I like to see in a business. I can see that the business is growing fast and has strong user retention. I could also see that the business is generating a lot of free cash flow, which is something you want in a compounding machine. You want businesses that generate free cash flow and grow it year after year. Capital allocation is also very important in a business, and the CFO of Uber explains how capital allocation could drive greater financial durability, which I believe is very true. A few other important highlights to note is that, like I mentioned before, the trips year over year grew 18%. The gross bookings actually grew 14% year over year to 42.8 billion, and the revenue grew 14% year over year to 11.5 billion. So all around, the growth of this company is extremely strong. I would also mention that it's nice to see 2.3 billion of free cash flow being generated, because free cash flow is also very important in a business. What they're expecting for Q2 2025 is gross bookings of 45.75 billion to 47.25 billion. So this represents a 16 to 20% year over year growth on a constant currency basis, which is extremely strong growth for the next quarter. I'm actually going to point out that stock-based compensation is actually decreasing quarter over quarter. So as you can see on the blue bar on the graph, this is stock-based compensation, and it has been decreasing quarter over quarter, which is very nice to see. And you could also see that they are buying back shares. So they actually started a share buyback program. So Uber, in the most recent quarter, they actually bought back a lot of shares, which is always nice to see. You can see how the share count is decreasing and stock-based compensation is decreasing. And this is something high quality companies tend to do. Of course, you want to see diversified revenue streams when investing, and Uber is very diversified. So I just pulled up the stats here, and you can see that Uber has 53% of revenue coming from United States and Canada, which is obvious because they're the biggest geographic locations Uber operates in. And then you have the Europe, Middle East, and Africa, which make up 28%, Asia Pacific, which makes up 11%, and Latin America, which makes up 6.36%. So this is a very diversified company. Uber operates basically worldwide, and they also have partnerships in between different companies. So for example, Uber has a partnership with Grab Holdings, and what Grab Holdings does is it's a food delivery service. Uber has a stake in them, and they operate in Asia. So we have different partnerships in between different companies. It doesn't just stop at food delivery companies. They also partner with Waymo in Austin and Atlanta. So Waymo is a company that Google owns, and it provides autonomous vehicles, and they actually partner with Uber for people to find a ride. That's not the only partnership they have. Recently they announced a partnership with Saudi Arabia, a company in Saudi Arabia that is launching autonomous vehicles by the end of year. So this is some major progress into the EV space, because we want to see companies that could benefit from the future prospects of robotaxis and autonomous vehicles. Uber seems to be in a good position to benefit from these new technologies instead of being taken over by them. Super investors also caught interest into Uber, and Bill Ackman actually bought a big position of Uber stock. So he actually has it as the biggest position in his portfolio at the moment. And this is something that always gives a bit of confidence in this investment, just seeing these big investors buy into your stock. There's a few important metrics I would like to point out in their Investor Day presentation that I feel like are very important for the future growth prospects of this business. So you have obviously the Uber One membership, and the Uber One membership is great because it provides recurring revenue and it emphasizes clients to actually use Uber more. If a client is paying for Uber One, that client is more inclined to actually do more trips every month. That makes them spend a lot more money on the platform. I'm not going to go through the entire presentation because a lot of this stuff I already explained previously. It just explains how the company is growing extremely fast and how they're forming different partnerships with other businesses. One thing I would like to point out, however, is the use of AI in Uber's application. The reason I point this out is because I feel like AI could definitely benefit this company a lot. I feel like a lot of investors underestimate the use of AI in companies like this because Uber is definitely placed in a good position to benefit from the AI infrastructure and the new upcoming AI capabilities. Uber could connect drivers with riders, and they could find the best routes and the most efficient ways to actually do this with the use of AI. Investors may underestimate these capabilities, but I feel like there's lots of tailwinds that will benefit this company going forward. What I also find quite interesting is that in the data, 50% of consumers actually only take 1 to 2 trips per month. If all consumers that take 1 trip per month take 2 trips per month, then that could increase the annual gross bookings by over 4 billion. And that's just an insane statistic to think of. That's literally not even adding new clients. That's just having current clients do more trips. So all around, Uber is growing extremely fast. It has partnerships with new AV companies. It also has a bunch of tailwinds that are going to benefit this company going forward. So what I did is I actually listed out all the positives for this company and I summarized them all in bullet points. So you have the strong growth of this company. It grew actually 17% year over year in the last quarter. It has extremely strong management. So the stock-based compensation is slowing down. They're doing less stock-based compensation, all while growing their free cash flow. And the free cash flow actually grew almost $2.3 billion in the last quarter, which is insane growth of free cash flow. Considering they're also buying back shares now means they're not diluting the shareholders either. So the stock-based compensation, like I said, is going down. They're not diluting shareholders. The free cash flow is growing. This is like the definition of a compounding machine. And these are the type of companies I love to have in my portfolio. Hence why I have over a 10% position in Uber. Of course, they have diversified revenue. So the revenue streams are actually diversified across different regions. So it's not only tied up to one specific country or region. They have partnerships in AV. So like I mentioned before, they have partnerships with Waymo and other autonomous vehicle providers. This just shows that Uber is positioned to benefit from autonomous vehicles. I would consider Uber to have a strong moat. I know many people would disagree with me and say that it's more narrow, but I think Uber won the ride-hailing sector. To drive in my point, I like to compare it to Netflix in 2022. So back in 2022, Netflix dropped almost 72%, and people were saying Netflix was dead because it was in competition with Disney Plus and a bunch of other competitors. But the thing with Netflix is Netflix actually won the streaming war, and I think it's the same case with Uber in the ride-hailing space. I think Uber has won the ride-hailing space war. Now, do I think Uber has no competition and no headwinds going forward? No, I do think Uber will definitely have to innovate down the line, and I do think Uber will definitely have to protect its moat down the line. But currently, I feel like a lot of the scares and headwinds that people say Uber is facing are not actually that big of threats. And last but not least, another positive of this company is the super investors that have been investing in Uber. So the most notable one is Bill Ackman, like I mentioned before. He actually has the biggest stake in Uber currently. Bill Ackman and a few other super investors have invested in Uber. So it's quite nice to see and reinforces that it's a good, strong company. Now let's talk about the bear case for Uber. The first and probably the reason why the stock is trading at a relatively fair valuation is the autonomous vehicle threat. Now I'm going to go on a little bit of a rant about autonomous vehicles because I feel like a lot of people miss the concept of autonomous vehicles itself. Currently, Google is paying around $100,000 to $150,000 on each Waymo vehicle produced. Let's make it a conservative estimate and say it only costs $100,000 per Waymo vehicle. So Google is paying upfront $100,000 for this vehicle to be a robotaxi. So they put this robotaxi on the road, but then they have to charge the robotaxi and maintain it because any vehicle has to be maintained. They have to pay the cost of maintaining the vehicle, they have to pay the cost of the vehicle upfront, and they also have to pay the cost of charging the vehicle. And all these costs add up significantly. Now, even if they have these vehicles run for 18 hours a day, it's going to take them years just to make back the cost of what they paid for the vehicle itself. So this is something to consider because every single robotaxi company has to make money. And if they want to disrupt Uber, they would have to become profitable. And a lot of these robotaxis are just not profitable yet, and I don't see them becoming profitable in the next few years. Cars were always liabilities to begin with, and Uber was smart by actually letting their drivers take on the liability risk. But the problem with robotaxis is that you're investing in liabilities to try to earn back a significant amount of capital. And when you do that, it becomes very difficult to become profitable because cars have a set lifespan. You're not going to have a robotaxi on the road for the next 20, 30 years. Over time, these components and the engine and the battery, they break down and degrade over time. And that's something you have to replace space over the years. So when you're paying an extremely high cost for a robotaxi, you have to consider that you're most likely not going to make a lot of money back on this investment. It's the same situation with AI data centers. So the components for AI, like the GPUs and the CPUs and the processors, these components degrade over time, and down the line, they're not going to be good for 10-20 years. These components last 5 to 10 years maximum. And when companies invest in these expensive components, they have to have a return on that capital in the next couple years, or else they'll be losing on their investment. All that to say, I don't think autonomous vehicles is a significant threat for Uber, but I did list it here as one of the bear cases. Next, of course, we have competition. So competition, there's always going to be competition with Uber. There's a lot of small companies trying to get into this space. Do I think that competition will overrun Uber? I do not, but I did put it here as just a precaution if you're investing in this company. And then we have regulatory challenges. So you guys all probably know Airbnb, and Airbnb was doing extremely well, but a lot of big cities actually banned Airbnb from being used in these locations just because neighbors were getting annoyed that a lot of people were renting out their apartments or their houses to Airbnb, and there was a lot of noise complaints and there was a lot of problems. So a lot of cities just actually banned Airbnb. This could be the same case for Uber. However, I do not think that this will happen just because Uber is such a big company at this point, and regulatory challenges might not always be the best for the consumer. So I just put this here as a precaution. I do not think it will happen. And lastly, we get the valuation. So what price should you be paying for Uber stock today? So analysts expect its free cash flow to grow year over year 20 to 25% over the next 5 years. So if we plug in a conservative 20% of free cash flow growth over the next 5 years with a price to free cash flow of 20, we get a compound annual growth rate of 16%. And I feel like these metrics are very conservative, which indicates that Uber is a strong buy today. If we lower the estimates significantly and put a 15% growth rate, we could see that we have a compound annual growth rate of 11.29%, which is still extremely good. Now let's move on to earnings. Analysts expect Uber to grow its earnings by 10 to 12%. We're going to put 10%. We assume that the shares outstanding do not grow and it has a price ratio of 20. We again get a 16% compound annual growth rate. However, if we lower the price ratio to 15, we get exactly a 10% compound annual growth rate. So depending on what you estimate Uber's future growth rate, you could consider Uber significantly undervalued. So it all depends on what you think Uber's future growth rate is. So will I be buying Uber at today's price? Well, the answer gets a bit complicated because I already own a significant position in Uber and I was buying around the $60 to $65 price range. I'm already up almost 40% on this position. If I was looking to enter this stock, I feel like now could be a good time depending on your future growth prospects. If you think autonomous vehicles will take Uber's market share, then this might not be a company for you to invest in. However, if you believe that the threat of autonomous vehicles is overblown, this company might provide significant value for you. I hope this helped and I hope everyone has an amazing day.